Hello. This is Mike Newmeyer, Game Plan for Retirement, and this is our regular podcast. And this is the third segment in the seminar series where we talk about different topics. And this is a seminar that we put together a few years ago, and I've updated and so forth. But I'm giving you the benefit of watching the seminar and hearing the seminar without attending the class. And so if you make notes, that's probably a good idea. And we've covered a couple of segments already. This is the third segment where we talk about investments today. Now remember, you can call me with questions. You can call me for an appointment to see me. You can talk to me about our latest offerings, what's available, exciting, and so forth. We have some products that are getting a 20% upfront bonus, 20%, big number, and providing lifetime income. So for you and your spouse, or if you're single, for you and so on. And they have beneficiaries involved, and they also have some long-term care benefits built into them. That's very important. Very important. They have what's called a doubler, which means that you'll actually double the income you're entitled to if you have to have long-term care help at home or in a facility. Okay, now let's get into today's topics. We're going to talk about investments, and these are the things I've written down. I'll go over with you. The considerations before you invest. You need to know what the categories are, so you pick the right categories to fit your needs. And cash accounts, and I tell people, and sometimes it really helps them, that we know where you can get almost 4% on money market accounts. You don't get them through me. I'm not earning anything on these, but it does help a lot of our clients. I had people in this morning. I gave them this information. If you call me, remember 410-902-0464, which I will repeat a number of times during our presentation today. 410-902-0464, Mike Newmeyer. Okay, so cash accounts, you need to earn as much as possible. Banks have not been paying very much, but we know some plans, as I indicated, money market's paying almost 4%, and a 1-year CD that's paying almost 5%. How bad can that be? Okay, call us and we'll send you in the right direction. Bonds, the bond market is one of those things that has never been very exciting to people, but if you can buy municipal bonds, especially in Maryland, which are triple tax-free, that can be very, very attractive. They're not easy to get, but they are available. And on every new issue, there's always a rush to buy them. But if you can get them, they're worth considering. Okay, and I'll tell you about bonds just so you understand that if you buy a bond that's $100 as an example, and is paying 10%, so it's selling for $100 and it's paying $10 dividend. Okay, $10 every year, you're going to get $10. All right, if that's a 10% return, isn't it? Okay. Now, if that same bond goes up in price because there's a lot of people buying it, let's say it goes to 15, let's take a number that's realistic. Let's say it goes up to $120. Now you've got the same $10, you're going to get the same $10, but you're not going to get a 10% return, are you? It's not going to be a 10% return. It's still $10, but the percentage is going to go down because the higher the price on the same bond, the lower the percentage, because the same dividend is paid. That $10 is always paid. So when people buy it later after the initial issue and the price goes up, then the return on theirs is going to go down. Yours will always be the $10. Okay, and if the price goes up on those bonds, you can sell them and make a profit. So that's a game that is played by a lot of bond investors. So that's the way that works. And then of course stocks, and basically we call the stocks that are bought by the consumer as common shares. There's another share called preferred. We're not going to get into that today, but common shares, what you hear about all the time that's being traded, common shares. And today, if you want to open an account yourself and manage it, you can use Ameritrade, which is part of Schwab, or any of the others, and they're very friendly and helpful, and they can show you how to do this kind of trading and so forth. Now, there's a lot more risk, of course, in being in the market with stocks. There's in a sense more risk than there is in bonds, but there's still risk in bonds. But the thing about stocks is that if you have them, you'd have to watch them, and you have to be careful, and you have to know what you're doing, which is, things that an awful lot of consumers are not really aware of, and really shouldn't be trading individual stocks. So then, that's that. What about mutual funds? Are mutual funds fail safe? You put money in and you don't have to worry about it and watch it. If you've got a 401k or a 403b or any of those kinds of, limited in contribution by your employer, and where you're allowed to do some matching, if you're buying mutual funds, which is what's in those kinds of plans, you have just as much risk as buying individual stocks. Now, you can buy safer mutual funds that are a blend of bonds and stocks and so forth. You can buy them based on limited risk, but there's no guarantees in mutual funds. Now, let me tell you a little bit about the share types. If you're buying mutual funds in your plan, you're going to get a plan of a type, but it's going to be an advisor. It'll be type A, but advisor type, where there's no fees charged to you. Now that's good, because in every other, if you're buying mutual funds on your own, no matter how you buy them, you're going to have fees inside them. Okay, a number of kinds of fees, and those fees are built in to provide a profit to the mutual fund industry. And you have to realize that's always going on. You're not going to have any free lunches. But if you're going to put money into mutual funds on your own, outside of a plan at work, the best bet you can get is basically, in my estimation, is to buy A shares, where you're paying up front the charges, the basic sales charge. B funds have lost a lot of their luster in the last several years, because B funds are charging you more money over a long period of time, and I don't recommend them. And so that's the simplicity of it. Now, if you're going to get involved with that sort of thing, and you're going to do your own trading, you can learn a lot from the companies that provide the platforms, as I mentioned, companies like Ameritrade, which is part of Schwab now. So they're very user-friendly. They can help you understand these kinds of products on more intimate information, more details. Then, of course, there's individually managed accounts. Now, individually managed accounts are basically accounts where you give a sum of money to an account, and then what you've got is an advisor managing it. And typically, they'll charge you 1% for accounts of at least $100,000. Many accounts are greater than that. And as you get closer to $1 million, you may find that they're willing to shave some of that cost to you, so that you're not quite paying a 1%. So that's important to know. And who you have managing your money is very important to know. You need good money managers. And if you're working with a broker or an advisor, they can turn you in the right direction, hopefully, and you get a good money manager. And money managers have to manage on a daily basis. So they're looking at, you can have funds that are managed conservatively. The older you are, the more conservative it ought to be. It could be for limited growth and income and so forth. So growth and income are basically two directions, or can be essentially one direction. In other words, it could be a blended fund that's being managed on a money market basis on that 1% annual fee. And they can create a situation where they can provide you with income on a regular basis. Now, a good money manager is going to provide you no more than the gains in that money. If you say to a money manager, I want X number of dollars, I want $2,000 a month, I want $5,000 a month, or whatever, and I want that no matter what, I want that amount of money. Well, if the market is not performing and they're not able to actually earn that amount of money a month that you're taking out, then what you're doing is you're eating into the principal, you're eating into the capital. And that is not a good way to go. And on the other hand, if you just say, I want to take the earnings, just give me the earnings on a regular basis, well, that's a lot more conservative. So you have to be aware, and you have to, I've seen people that just don't understand that. They think they can just take the same amount of money out every month and they're going to maintain their fund. And this just can't happen. All right, so be aware of that. You'll hear people say, well, the market grows 10% a year, so I ought to be able to take 10% out. The problem is that's, first of all, is not true. If the market goes down and comes back, it may earn 10% then, yeah. If it's down for a couple of years that you're not getting that 10% growth, but you continue to take this 10% out, well, look what that's doing to your actually invested capital. It's reducing it. So you're hurting yourself. You need to understand and work these kinds of things out before you get involved with managed money or anything else that you're going to take money out of. And that includes mutual funds or any other stocks, whatever. You know, if you have to understand the consequences of your decisions and your direction to the people that are actually managing your accounts. Okay, tax deferred annuities. Well, first of all annuities are tax deferred. Now, what does that mean? We are in the business, of selling and providing annuities to clients for lifetime income. That's basically our thrust. That's our mission. And we take rollovers from 401ks and other plans, and we put them into the kinds of annuities that will guarantee you lifetime income. They can't go down in value. You're not reducing them each year by taking that money out. You're going to get that same amount of money every year. You're not going to have to worry about that income, endangering the money that you're taking out, endangering your lifetime income. That's not going to happen. You're going to get that income. Some people say, well, that's miraculous. That's too good to be true. Well, come in and see me. Remember, Mike Newmeyer, 410-902-0464. 410-902-0464, and I will explain these things to you in great detail, and I'll explain how they can do that. But they not only can do that, they are doing that, and I have been selling these products for almost 25 years. So believe me, if they weren't good products, then I wouldn't be in business, would I? In 25 years, I've served almost 700 clients. 700 clients that have gotten lifetime income. So give me a call. All right, so that's the way annuities work. Now, there's two kinds of annuities, and the only one that can really guarantee you lifetime income safely are the kinds that we sell. But there are other annuities that are basically tied to the market. Those are variable annuities, and they've lost a lot of favor through the years because essentially you're relying on the company that's managing those mutual funds, which are inside of the variable annuity. That's why it's called variable, because the values can go up and down. So the only kind that can safely guarantee you lifetime income, are then the ones we're talking about, which are, fixed index annuities. And those have, incidentally, let's say you're not going to start income immediately. Many of them have what's called a roll-up. So you might get a big bonus, like we have some right now that are paying 20% bonuses. 100,000 becomes 120,000, and then guarantees you a roll-up for some period of time. And one example I'm thinking of, you can grow by 7.5% a year for up to 5 years. And if you leave it alone for 10 years, it's going to be more than double in value. So we have lots of products. We always go back to the question of event horizon. Sounds like a funny couple of words, but event horizon only means when are you going to start income? And we want to make sure you've got as much income as you can start taking at that date. So if you come in and say, I'm going to retire and I want income in 3 years, okay. I'm going to retire, I'm going to want income in 5 years. Now we can pick and choose the kinds of products that will maximize the income for you at the time you're going to start the income. And that's very, very important. So all annuities are tax deferred. You don't start paying taxes until you take the money out. So when you start income, that's when you're actually going to take, you're going to actually have to start paying taxes. And so those are some of the kinds of things that you want to think about. And you want to think, where are the risks? The biggest risk is the market. And the second biggest risk is your age. Because if you're in the market and you're down, how much time is there to recover? Are you going to recover in your lifetime? What's it going to do to your income? Can you rely on that income during your lifetime and your spouse's lifetime? Well, the variable products, the stocks in the market, the variable annuities and so forth, they have a very hard time providing you with lifetime income. So those are just some thoughts. And how much time we got, producer? So we are at 10, we've done 10 minutes. Okay.
16 minutes.
We've done 16 minutes. All right, we're going to stop it right there and we'll pick this up on the next segment. Now watch for the next segment. And we'll be back real soon. And just all you got to do is go in and put Mike Newmeyer in there and you'll find me. You'll find my podcast on how many different platforms, Miss Producer? What are they?
Facebook, Instagram.
Facebook, Instagram.
Twitter.
YouTube. Those are the main ones.
LinkedIn.
And LinkedIn. Okay, so there they are. Whichever ones you like and are familiar with, just go into them, Mike Newmeyer podcast, and you'll find us and look for us. And we're going to look for you next time we film. Okay? Great looking at you today.